If their feet toward the front, it's like in class. You can come down here. We're so glad you're here. I'm Pam Church, Director of the Master's Program in Accounting here at Rhodes, and we welcome all of you. We have alums, we have students, we have faculty members, and we have members of the business profession, and just interested people from the community, and I think that's wonderful. I told them what I was afraid a pretty day might work against us, but we have lovely sunlight in this lovely room. I want to welcome you on behalf of our sponsors, the MS in Accounting program, the Program in Political Economy, the student chapter of the Financial Management Association, and the Rhodes Office of Alumni Relations. And for those of you who don't know, this is homecoming season here at Rhodes, and our event is part of that, as well as an activity from all of these different sponsors. Let me take care of some business. As a college, we can offer you 1 hour of continuing education if you're a CPA. Certificates will be ready at the back where you signed in at the end of the speech. So pick those up, please. If you did not know your license number, just send Linda an email, Linda Gibson, and she will record that because we have to keep our records. Also, let me be sure to invite all of you to our reception. This is a networking reception for all of you to interact with our students and with Jonathan Weil, and we think that that is such a great opportunity for everyone, and certainly good for our students to be able to interact with people from so many areas. So I hope you'll come. The problem is it's not here, it's in class. So when you go outside, if you go out facing the statue, that's the best way I know how to tell you. Turn left and just follow the sidewalk. It's in the oral room of class. So you follow the sidewalk, turn left at the first building you come to, and you're going in a side door, go up one flight of stairs. That's the oral room. Ask any student, they will tell you where it is. So please join us for that. I certainly want to thank Jonathan for being with us today. It really is a sacrifice on his part to come to Memphis to share with us, and this is the purpose of his trip to Memphis, Tennessee today. And I want to thank him for already making my classes more relevant this semester. I have been reading some of his past columns, and I have found so many ways the columns are relevant to what we study in accounting classes. I have mentioned Jonathan as I have talked about the Wall Street protesters because of the bailout, Steve Jobs because of stock option dating, and certainly the boring chapter on the balance sheet where we memorize where everything goes, because he steps back and ask, should this category even be here, or is this hiding something? And what would serve the needs of the users of the financial statements? And that's a much more interesting way to look at it than what's supposed to go where. He certainly knows what's supposed to go where according to the standards, but he questions and asks about the big issues, as I think all of us should be doing. And what a great perspective to bring to liberal arts students, because we hope that when we send our students out into the world that they are asking those big questions and not simply cranking out the numbers and not asking, why am I doing this and what does it mean? So we're excited about that. Why were we so fortunate to have Jonathan with us today? Well, we owe it to Chris Nunn. Chris is our alum of the undergraduate program at Rhodes, the master's program at Rhodes, and he is the Chief Financial Officer of Security Bank Corp, and he's also teaching our auditing class for us. Steve shares the passion that Jonathan Weil has for analyzing complex issues, cutting to the core of them, and determining how they impact individuals and society as a whole. And I think that he developed this association with Jonathan because they started this communication about issues that you'll hear so much about today. So we appreciate Chris's passion about bringing this to our attention and facilitating his visit today. So if you've talked to Chris at all in the last couple of years, you've probably heard him mention his Bloomberg buddy. That's my Bloomberg buddy that said this in this column he'll always say. So I am going to let Chris introduce Jonathan to you because he knows him a lot better than I do, and he is very qualified to do so. Thank you very much.
Mr. Microphone, is this okay?
Yes.
Okay. Let's see, I did get to know John in about 2009, and as was said, I'm a CPA and a banker, so my world went to hell in a handbasket in 2009, plus I had my third child who didn't sleep. So I spent a lot of time up at night reading and began an email correspondence with John. But John does a very good job of not just being an opinion writer, but being an investigative journalist that has really uncovered some very interesting, anything from scandals to news stories over the last few years. And his writing style is very entertaining as well. He has been, at times, very critical of both the banking industry and the CPA profession, of which I'm a member of both, but in every article that may bring up some of those weaknesses, I've yet to be able to find an area of disagreement with him. His work is very factual and relevant. So I think we really are lucky to have him here today. I would highly recommend that we make this an interactive event. He's got a wealth of knowledge, and I'm sure he would much rather engage the audience and answer questions than to give a lecture. So I would highly recommend throughout the lecture, whenever you hear anything that interests you, you want to hear more about, you disagree with something, raise your hand and keep this interactive and fun, and I think it'll be very enjoyable. But if you'll give a hand to John Weil.
Thank you for coming out. This is a good turnout. Tell you a little bit about myself. The other thing too is I just love coming to Memphis. I have family here. I have cousins in the audience. My mother grew up in Newport, Arkansas, and I've been eating rendezvous ribs since I think before I was even born. So it's really a treat to come down here. And since I'm here, I'll start off by telling you a funny Memphis story, in particular a funny Morgan Keegan story. I don't know if you've been keeping up with local business press over the past few years. Morgan Keegan's this regional brokerage. It's owned by Regions Financial, had a really bad scandal with some of the mutual funds. They were telling the investors in these mutual funds that the assets in these funds were worth more than they actually were. And the SEC, and this led to a column I did about a year and a half ago, the SEC came down, accused certainly some of the people who worked there of fraud. I can't remember if it was actually a fraud claim against the company itself. But in any event, long after the funds had pretty much collapsed, and the SEC moved in, I think some of the other state regulators moved in, and I had noticed that after all this time had passed, these funds had collapsed. You even have the Securities and Exchange Commission accusing people who run the fund of fraud. The auditor, PricewaterhouseCoopers, still haven't told their audit opinion yet. They need to believe PricewaterhouseCoopers, even though there is this horrible thing that happened, and the investors have been lied to and lost a lot of their money. A lot of people in Memphis lost their money. They're still saying, oh, they're still in conformity with generally accepted accounting principles, etc. You call them up on the phone, they wouldn't talk to you. They're just, wow, just wouldn't engage at all. And so I did a column on it. Pretty standard type of stuff for what I do. But I also noticed, and this is getting to the funny story, that I haven't written about it yet. I just haven't found the opportunity to. But I noticed that on the audit committee, which is the committee on the board of directors of the funds is supposed to be looking at financial integrity, overseeing the auditors, all that. There was this fairly well-known academic by the name of Mary Stone. She's an accounting professor at the University of Alabama, the Culverhouse School down there. And I noticed she was on the audit committee. She was very active in a lot of accounting academic circles, and I was thinking, well, that's not good. That's not a good career move to have been on the audit committee of Morgan Keegan if you're a accounting professor. kind of tucked that away in the back of my mind. And about 6 months later, at the end of 2010, I see this press release come out. And it's from the Financial Accounting Foundation in Norwalk, Connecticut. This is the nonprofit body that oversees the Financial Accounting Standards Board, which sets U.S. GAAP for the entire country, and pretty much, the leading set of accounting standards for capital markets globally. And lo and behold, they had just named Mary Stone to be a member of the Financial Accounting Foundation. And I think, okay, and the point of this thing that this is perfectly normal. This is perfectly normal behavior in the worlds and the markets that I cover. Where you can then, in charge of making sure fraud doesn't happen, and, this huge mutual fund complex with billions of dollars under management, and still, even when the fraud scandal breaks, have it completely not affect your career whatsoever. So a little Memphis tie kind of gets you in the type of thing that I think about and do all there. And then you look at Morgan Keegan's parent company, Regions Financial, based in Alabama. They're reporting earnings are there'll be losses on Tuesday. And just another type of thing I look for. I look for glaring irrationalities in the capital markets, and particularly in financial institutions, balance sheets and financial statements. And one of the reasons the Regions is probably an important representative of something is that they're probably right on the cusp of who's considered too big to fail. About $130 billion in assets. Shouldn't be too big to fail. It probably is because a couple of years back, the Federal Reserve, when they were stress testing all these banks in the U.S., included them on the list of 19 companies that got stress tested. Presumably, that was basically a guarantee from the government that they wouldn't let Regions go down. So here are just some numbers for you. Before I start off, let me tell you about my favorite accounting entry of all. It's called Goodwill. Goodwill is where, let's say there's a company out there that is, their net assets, or assets minus liabilities, is $1 billion. I go pay $2 billion for it. Well, I put down $1 billion of goodwill. If you want to know what goodwill is, you're breathing. Basically, it's a pneumatic, air, the stuff you find inside of an empty brown paper bag. So if you look at it, it's non-saleable. You can't sell goodwill by itself unless you sell the entire company. So if you look at Regions, here's some numbers for you right now. Their stock is trading for about 34% of their net assets, or their book value, as a common shareholder. Which means Mr. Market doesn't really think that their numbers are very helpful. The company's stock market value is $4.6 billion. And their goodwill as of June 30th, it was $5.5 billion. So the goodwill in Regions, we're supposed to believe, is worth more than all of Regions Financial Group. And after the Morgan Keegan scandal, who knows, maybe that's true. But it's just one of these things where this is the easy stuff. And these are the types of things that continue. If you think it's bad here, just wait till I get to start talking about Europe. But, and then you look a little bit more in their financial statements and you realize that they tell you flat out that their loans on their books are worth $8 billion less than what the balance sheet says. The so-called fair value, as opposed to carrying amount, because due to the wonders of the influence of the financial services industry, every time the Financial Accounting Standards Board, my guess is that Mary Stone is probably sympathetic to these concerns, every single time the Financial Accounting Standards Board, which sets GAAP, tries to change the rules so that you have to show loans what they're worth, the banking industry gets like 20,000 bankers around the country to send emails and flood the board with protests. So invariably, they always keep loans at cost. So anyway, you look at this bank, you're just looking at the financial statements, so you take away the goodwill, take away the difference between the fair value and the carrying. Oh, this bank is pretty much, I don't want to start runs here or anything like that, but technically it's insolvent. But does anybody tell them, write down your goodwill? This is embarrassing. They've had this problem before and they finally write it down. But I'll be really curious on Tuesday to see if they end up having to do this. Now, again, important point. This is all normal behavior. This isn't, we're talking about Regions. You might just think that this is an Alabama problem or something like that. No, it's a North Carolina problem too. You look at Bank of America. That is a national problem. Okay, the same situation. They just reported an incredible $4 billion profit last week that nobody seems to really take all that seriously, judging by their market cap, which is about 31% of their common shareholder equity. 5 years ago, the company was trading for like 2 times book value, and now they trade for about 30% of book value. So the market's telling you, oh, we really don't think that those are what your liabilities are actually going to be. They're going to be a lot more because of all these lawsuits about mortgage repurchases from buying Countrywide and whatnot. Or just look at their goodwill. $65 billion market cap, $71 billion of goodwill, that I checked yesterday. This is Bank of America. That's $2.2 trillion of assets. Now, the beautiful thing about when you look at something like this is that then you dig into a little bit further. Countrywide was probably, I used to say that AOL, the purchase of the combination of AOL and Time Warner back in 2000 or whatever, 99, whatever it was the single worst corporate acquisition, most disastrous, harmful acquisition in the history of U.S. capital markets. Countrywide, the acquisition of Countrywide by Bank of America, far exceeds. And then you start looking into the details, as far as the harm it brought to the country. You start looking into the details of the way Bank of America accounted for that acquisition. Well, they paid $4.2 billion for Countrywide. But they miraculously couldn't find anything of value when they bought this company. They took assets and subtracted liabilities, and they found that when they bought this company, it had net liabilities of $200 million. So you just got to wonder, why did they buy this thing when they saw no value? Well, the upshot of that is when they do that, they book goodwill of $4.4 billion. It's no secret, which is, again, more than the purchase price. You ask, what did they buy? Well, it's no secret, again, Countrywide, most disastrous acquisition in U.S. history. As of a year ago, September 30th last year, they hadn't acknowledged that Countrywide had lost a single dollar of value, even though, again, it was the most toxic, horrible acquisition ever made in U.S. history. They finally started writing that down fourth quarter of last year, but to this day, they've still got, this is one of these companies that's a big Pac-Man machine. So they have grown entirely by acquisition over the past 20, 30 years, when it was started out with North Carolina National Bank. Basically, and now they're to the point where they have no internal growth engine left anymore. And there's nothing left that they can really buy. They've already swallowed Merrill Lynch and Countrywide, and almost killed them twice. That's what the TARP bill has swallowed up. So, but here's this company again. When you see something like that, you almost think about it in terms, and I'm a lawyer by training, like a lawyer with a witness on the stand. Something like that is just impeaches the heck out of credibility. When they have a number like that in their books, they're basically telling you, especially when they're telling you like Countrywide goodwill a year ago wasn't impaired. You cannot believe a single number on our financial statements. They might as well be looking you in the eye and saying, I am a deaf mute. And those are the types of things that I look for when I'm looking for columns. Because accountants, there's a thing in the culture where, and not just accountants, but people who prepare financial statements who aren't accountants, or just on Wall Street generally, they talk about these financial statements. Oh, it's so gray. There's so much technical expertise that goes into preparing these, and you have to understand there's a lot of subjectivity and professional judgment. But the thing is, one of the reasons we've gotten this financial crisis we've had, it's not even a crisis anymore, it's just normal over the past 4 years, is that there's a complete breakdown of trust. And the reason there's a complete breakdown of trust is that people get lied to in the face. And the people who lie to them in the face expect them to believe it, or at least try to create the pretense of the expectation that the markets will believe them. And then when that pretense just disappears, that's when everything really falls apart. And we get the situation like we're in right now, where, again, if you think it's bad here, look over in Europe, it's far worse. You have, all the comments prime ministers meeting over the weekend, yet again, to try to figure out how to save their financial system. And let me just kind of tell you, this isn't something, my approach really hasn't changed all that much since I started doing financial reporting over the past 15 years or so. One of the stories that was really one of my early introductions to accounting, but it was a story, it got me the job as the accounting reporter for the Wall Street Journal in 2000, was a piece I did when I was living in Dallas, writing for the regional edition of the Wall Street Journal, about the energy traders at Enron, Dynegy, El Paso, and I probably could have included a bunch of other companies. But these were in 2000 were the first big post-dot-com bubble. They were supposed to be the marriage of the old world and the new world, or the old economy and the new economy all wrapped up all in one. And I think Enron at that time was focused on them. This was September 2000 when the story ran. They were they're trading for their all-time high, about 80 times earnings. And one of the things I noticed with their numbers was that I was talking about before how loans are never, their actual value of the company's books. This was the opposite extreme. They were valuing things that they had no business value, and creating huge gains on their income statement, on their balance sheet, to show huge numbers so that Wall Street would then put a huge multiple on their earnings. And I can remember the story that ended up running, the headline on it was Energy Traders Cite Gains, but some math is missing. Again, it was about Enron and Energy in El Paso. And I can still remember sitting down with the chief accounting officer and like 7 other people that flew up to Dallas for this meeting I had. And I told them, look, this is your last day for reporting at the Common. So I've been trying to get in touch with you for 2 weeks now. They flew all these people up. They give their big dog and pony show about how they had all these, and the big thing there was that they were valuing, like taking electricity contracts and natural gas contracts that extended out like 25, 30 years over time, and supposedly valuing them and miraculously recognizing huge profits, non-realized, on-paper only profits every single quarter, and the earnings were just going straight through the roof. And so I remember sitting down there, how are you doing these methods? I wanted to understand the methodology for how they're recognizing all these gains. Went through the same process with Dynegy and El Paso too. And they were telling me about all these geniuses, PhDs they hired from MIT or Caltech or Harvard or Stanford, and how they really got the brightest minds in the world to figure out how to value their contracts for their time groups. Okay, great. So it's 2000. I know this is a long time ago, outside of the institutional memory of a lot of people in the room, but let me try to just give you some perspective. It's 2000. See, how long this is kind of how the questions went. So Richard Fox, by the way, I think he's still incarcerated. How long after these contracts? 30 years. Okay. How long have you been in this business of trading electricity and natural gas contracts? About 9 years. Okay, so your 9 years of experience gives you a lot of insight into what's going to be happening in the future 30 years from now. Absolutely, no doubt. We've got the best minds, MIT, PhDs, etc. Okay. I don't know if you remember hearing stories about rolling blackouts that were happening in California in 2000. But basically, what we know now is that, like, the Enron and Dynegy had figured out ways to manipulate the electricity markets out there. And that's what was causing a huge spike in prices. But again, this is 2000. So I asked these folks who were assembled at the table, were your mathematical models telling you last year, in 1999, electricity prices would be going berserk in 2000? Oh, no, of course, absolutely nobody could have predicted that. It was a 100-year flood type of thing. Nobody could have ever seen something like that. Okay. Well, it's September 2000, the presidential election's in about 6 weeks. 6 weeks. Who do you think it's going to be like, Bush or Gore? Well, it's really too close to call. This Nader thing going on. I mean, who really knows? Don't you think it matters to your mathematical models whether or not a Republican Texas oil man is elected president or an environmentalist Democrat? Well, I see your point, but with models, there's some things that are just always going to be in there. I walked out of that room and I thought, even if these guys were acting in good faith, they can't possibly be doing what they claim to be doing. And this company had suddenly vaulted into the Fortune 500. It's like the number 7 spot overnight. And so it really didn't surprise. And it turns out there's a story that story started a whole daisy chain where there was a big short seller I didn't get to know until years later named Jim Chano, who saw that article. Within a week after reading the annual and quarterly reports of these companies, shorted Enron and Dynegy and a few other companies I hadn't even written about. He told a woman named Bethany McLean of Fortune magazine, who then did a piece in early 2001, the headline is Enron overpriced. Some other people piled on. Regulators in California figured out how their Enron and Dynegy were manipulating electricity contracts. The electricity markets out there, the rolling blackouts stopped them. These commodity prices plunged and Enron stock went down with it. We didn't know until years later the way they structured the company, as soon as the stock fell below $60, that they were in a death spiral, and well, now it's in history. But that kind of goes to the same thing. The way they answered those questions, there were no answers to those questions. And the financial crisis today, you pose the same types of questions, and that's how you know when a company is in trouble, when they don't have good answers. If you look at I did a lot of stories in 2007 or early 2008 about Fannie Mae and Freddie Mac, the government-sponsored housing disasters. And they had the same type of thing going on. They would have billions and billions of lawsuits on their books a year before they blew up from securities and various toxic mortgage-backed securities that they had bought from the likes of, or guaranteed or bought from the likes of Countrywide and whatnot, where the accounting rules are set up so that they say, well, if the losses in your mind are only temporary, then you don't have to include them in your earnings. You don't have to include them in what the government says your capital is. So lo and behold, they've had these tens of billions of dollars of losses at Fannie Mae and Freddie Mac, and the companies and the auditors, they were always temporary. They were never, they were never saying, no, they never lost any money. Or they would have these things called deferred tax assets, which is another beautiful little accounting entry where the more money you lose, the more your deferred tax assets are worth. Unless you decide that, you know what, we're kind of doubtful about our ability to be profitable in the future. In that case, you have to write the deferred tax assets down. This is what happened like with Citigroup, where they needed a second bailout and another $20 billion or so in late 2008, and their deferred tax assets were supposedly worth like 6 times more than the company. Of course, they were worthless unless they were going to get a government bailout, which is what happened there. Freddie Mac and Fannie Mae, they didn't write down their deferred tax assets, again, tens of billions of dollars, worth more than the companies themselves, until long after they got taken, until actually, I think right after they got finally seized by the government. And we see this same type of scenario play out over again. Freddie Mac, I remember doing a column in 2008. It was really Enron all over again, but in the sense of companies possessing magical powers to predict what's going to happen 30 years in the future. They had these derivatives on their books they call cash flow hedges. Doesn't matter what a cash flow hedge is. The purpose is, the point is that they were supposedly going to be hedging transactions that are occurring as far out as 30 years into the future. Nobody knows what's going to happen 30 months into the future, let alone 30 years. But they claim the magical ability to do that. And by claiming the magical ability to forecast transactions 30 years into the future, they were able to keep the losses that were on these derivatives that were supposedly hedging these magical future transactions out of their earnings, out of their capital. They say, oh, these losses, well, you see, their hedging transactions are going to happen in the year 2031 or the year 2041. And so we'll only recognize the losses if the transactions end up happening or not happening in a way that's different than the hedges are behaving. I'm not making this up. This is the way the standards would work. And this is how the regulators said, okay, or PricewaterhouseCoopers or Freddie Mac would say, okay, or Deloitte would just go along with this. And we write about it in the press. So there's no excuse for the Securities and Exchange Commission or the auditors or the Justice Department to not know what was going on. And yet it was still going on. Okay, they're just going to keep this up until they collapse, which they did. Lehman Brothers, a number of us in the press are writing stories warning about some of the items in the financial statements that just didn't make sense. If you look at their the first quarter they reported, I think for 2008, which was the year they blew up, they had these, more than 100% of the earnings for the quarter came from these miraculous gains on some private equity investments when the entire private equity market was collapsing and the stock market was falling out of bed. And they would never tell you, well, what are these backed assets? What are these investments that supposedly had this miraculous $600 million gain on, only a $600 million investment in the course of 3 months? And they wouldn't tell you. There was stuff like that popped throughout their books. I mean, by the time September 8 rolled around, I'd done columns on, along these lines.